All right, one more to go after this. So here we're going to take a look at another group of ratios and their importance to decision makers are those concerned with profitability. Creditors are always concerned with profitability because it indicates an ability to make required principal and interest payments. Stockholders are always very interested in profitability because of related increases in stock prices or dividends that might be paid to the shareholders. Managers obviously are also very concerned about profitability because often it's related to their performance evaluation and or tangible rewards from bonuses and incentive compensation plans. So when we look down profitability ratios, everyone that you deal with pretty much has an interest on whether or not the company is profitable or not. So now we're going to go ahead and take a look at some of those ratios, their information from the financial statements from. So the first is the asset turnover ratio, and this measures the sales generated as a percentage of its assets. If you remember back in Accounting 210, we talked about that assets help to generate revenue. For instance, if I own a piece of equipment and I'm making water bottles, and that piece of equipment makes water bottles. So I want to make sure that that asset is turning over and making me as much sales as it can. So in the case of Robin's Boutique, this ratio is declined in the current year per the previous year. Lowest asset turnover ratio is a concern to management. It means that the assets I have are not churning as many sales as I would like them to. So in this case, they're generating 0.94 times, and in 2012, they're only doing 0.84 times. The way that we calculate that is we take the net sales from the income statement and the average total assets. So that would be beginning total assets plus ending total assets divided by 2. So by now you're probably getting the feeling that I'm going to need that cheat sheet from the back of the book, and I'm just going to need to be able to do some math on my trusty new calculator. So let's go ahead and take a look at the next one that helps us with profitability, stockholders' equity. Sometimes this is called ROCSE, and it measures the return the common shareholders, net income reduced by preferred dividends, as a percentage of stockholders' equity. These ratios indicate that the common stockholders are earning about 17% return in 2011 and about a 14% return in the current year. Remember that your stockholders are the ones who give you money in exchange for stock. So the fact that they gave you $10,000 and it's earning 17% or 14% is a very good investment. Adequacy of return on stockholders' equity always depends on a number of factors, including what is the risk of the investment. Please note, if you ever take a finance class, that the higher the risk, the higher the reward. Let me use my trusty eraser. The higher the reward typically means also the higher the risk. So risk is always associated with reward in investing. So how do we make that calculation? We take the net income from the income statement minus any preferred dividends. So in most of the cases, making this in real life companies, this probably is going to be 0. Average over the average common stockholders' equity. So again, it's beginning stockholders' equity plus ending stockholders' equity divided by 2. That's always the formula when we're looking for average of any of these counts, inventory, accounts receivable, and so forth. So once we do that, one of the ones that we really see most per share, or better known as EPS. Current shareholders and any potential investors use the EPS, or earnings per share, as a measure of performance, often a very key measure of performance. In contrast to measures of net income, EPS can be used to compare the performance of companies of all different sizes. However, as with anything, we should use caution in comparing companies across different industries. We want to be able to look at most companies within the same industries. So how do we come up with EPS? Net income minus preferred dividends, which in most cases will be 0, over the average number of common shares outstanding. Again, it would be beginning plus ending divided by 2 would equal this. The last one that has to do is the price earnings ratio. And what we use to do this one is the current market price divided by the EPS. Investors are always interested in what the current price of a company's stock is in comparison to its earnings. So the PE ratio is a reflection of the industry's growth prospects, in addition to how optimistic investors might be about the future of a particular company and its earnings. If a company has a PE ratio that is higher than the industry average, it typically will mean that investors think the company will outperform other companies in the industry. But I heed you on this. Don't let that sway you. If it is really higher than the industry and investors are really high on the company, is it real, or could it be inflated like Enron? Always remember, sometimes it really is better, it is worse than it looks. That the frosting on the cake isn't always the best. So one more video to go, having to deal with solvency ratios, and then you'll be ready to have your little list of ratios, get into your groups, and we'll work some numbers through and have some discussion among ourselves. So I'll be back soon.